Great. Welcome, everyone, to the third roundtable on our credit losses standard, commonly referred to as CECL. I'm Alex Cassis, and I'm on the CECL Post-Implementation Review, or PIR, project team. So this meeting is being live streamed on our website, where it will be archived for future reference. So the purpose of this meeting is to listen to and gather feedback from a broad cross-spectrum of our stakeholders. And today's feedback forms part of a larger mosaic of feedback that we've been compiling over the years. And that cumulative feedback will be used in the development of a PIR report. Now, we're calling this a roundtable, but really it's a 10-year reunion. The standard was actually issued 10 years ago next month. And so, as with any reunion, we're gathered to reminisce on our shared experiences with CECL, not just over the past decade since it was issued, but we'll actually be traveling back 20 years or so to when the board was first contemplating changing the guidance for credit losses coming out of the financial crisis. However, our PIR process is not just about reflecting on the past. We also have an eye towards the future. So our current board members were not on the board at the time that CECL was issued, but what are the lessons learned from the CECL experience that current and future boards can consider and think about as we work on developing future accounting standards, not just for credit losses, but across all areas of accounting. So before we kick off the discussion, I have some standard administrative matters to get out of the way. So the first one being introductions. Let's go around the room and I'll ask everyone to identify their names and their affiliation. And then I will introduce everyone who is joining us remotely. So for those of you who are new to this, when your time comes to speak, just press the button on the mic. It will turn green, indicating it's on. And then after you're done speaking, make sure you press the button to turn off the mic. So I'll start with Dan.
Yeah, good morning. Dan Stuhlheimer, FASB staff.
Michael DeMarco, FASB practice fellow.
Rosemary Sangiulo, FASB Deputy Director.
Hi, I'm Jack Day. I'm the Director of the FASB staff.
Marcia Hunt, FASB member.
Good morning, Chris Seidlich, CFO, Main Street Bank.
Christine Bodison, FASB member.
Damon Dalmonte, KBW Equity Research.
Jay Cochran, Truist Bank.
Good morning. Mark Norton, KPMG.
Joyce Joseph, FASB member.
John Howard, Deloitte.
Nellie Debler, FASB Deputy Director.
Amanda Friedel, Chief Accountant, OCC.
Doug Ewell, Chick-fil-A, and the Private Company Council.
Hillary Salo, FASB Vice Chair.
Good morning, Brian Johnson, Chief Accountant at the FDIC.
Heather Jassam, PCOB, Office of the Chief Auditor.
Rachel Minson, Securities and Exchange Commission, Office of Chief Accountant.
Rich Jones, FASB Chair.
Good morning, Sue Cosper, FASB.
Brett Dooley, PwC.
I'm Graham Dyer with Grant Thornton.
I'm Mike Gillette with the American Bankers Association. Now, the ABA serves the entire banking industry, and I'm ready to talk about anything. However, we did recently have a comment letter that addresses the concerns specifically by our community banking members, and I certainly hope such issues take priority today.
Good morning, Chris McGrath, Chief Accountant, NCUA.
Kathy Shakespeare, FASB.
JP Shelley, Crow.
Fred Cannon, FASB member.
Matt Whip, EY.
Shandy Smith, FASB Investor Liaison.
Julie Young, FASB Staff.
John Schomburger, FASB Postdoctoral Fellow.
Ari Skolnick-Schur, FASB PTA.
Sam Steigenberger, FASB PTA.
And joining us remotely from the Federal Reserve, we have Vice Chair Michelle Bowman, David Cook, Francisco Covis, Greg Frischman, and Alex Wells. We also have Joe Stuyven from Stuyven Capital Advisors and Catherine Mueller from KBW. So moving on to the agenda, we've organized the discussion into 4 topics, which are outlined in the meeting materials that were distributed in advance and are posted to our website. We'll give a brief tee-up to set the stage for the discussion. And then for each topic, we have a series of discussion questions. So with respect to the discussion, we're following our standard format for these types of meetings, which I think is familiar to most of you. Responses will be handled on a first-come, first-served basis. If you would like to weigh in on the discussion, just flip your name card vertically, and we will add you to the queue. And for those of you joining virtually, just click on the virtual hand under the React menu on the bottom of the screen. If at any point you need to make an urgent comment that can't wait in line, our standard practice is to do the touchdown pose. So just raise both arms and we will escort you to the front of the line. And then with respect to the microphone, so if you're in the room, like we just did, just make sure you press the button to turn the camera on and be sure to turn it off. And for those of you joining remotely, please make sure you have your Zoom muted until it's time to speak. And finally, we do have a break scheduled in the middle. However, feel free to step out as needed. So I'll now turn it over to Dan to tee up topic 1 on benefits.
All right, good morning. The first topic we would like to cover today is the benefits of Update 2016-13, or CECL. The board issued CECL to improve the timeliness and transparency of credit loss recognition and provide financial statement users with more decision-useful information about credit risk inherent in financial assets. As part of the board's post-implementation review, or PIR, the staff has performed extensive outreach with investors, preparers, practitioners, and other stakeholders to understand the effects of CECL and evaluate current practice against the board's initial expectations. The PIR feedback has been wide-ranging. However, most stakeholders generally agree that earlier recognition of credit losses provides more decision-useful information. Supporters have said that CECL improves the timing of loss recognition and enhances the transparency of an entity's exposure to loss, while critics have expressed concern about potential second-order effects of CECL and raised questions about consistency, comparability, and operability. Support and dissent have been fairly balanced throughout PIR. However, the staff has observed recent feedback trend towards neutral. Given that context, we'd like to start by hearing your assessment of the decision usefulness of financial information reported under CECL from your perspective as a preparer, investor, practitioner, by going through the questions 1 through 3 in the handout.
Okay, great. So as Dan mentioned, we have 3 questions for topic 1, which are on page 9 of the meeting materials. Now, for this topic, the focus is on benefits. And I realize there may be a natural tendency to start talking about costs as we're going through this section, but to the extent possible, I'll ask for you to hold off any cost commentary until we get to topic 2 on costs. So I guess to kick off the discussion, I see Mike Gillette, if you'd like to start.
Thank you. I just had a comment, maybe a request, as the feedback is given. Perhaps if you can kind of differentiate between information provided by the number versus the disclosures. And then also maybe even if you can get more descriptive as to the kind of loan type, whether it's commercial loans versus a consumer. As we've talked to our analysts, it kind of varies based on each of those types. And it might even go back from community bank versus commercial bank too, or I'm sorry, versus larger bank. So thanks.
Is there anybody else who would like to weigh in on topic 1 here? Yes, Chris.
Good morning. In thinking about CECL and its appropriateness or usefulness, one thing that was nice about it was for credit unions, we took a step back and took a look at credit losses again. And over time, I think we've our people have developed more analytical skills as they analyze something that they hadn't taken a looked at for a while. The incurred loss method was used forever. and having to go to a new method caused them to take a step back and reassess and try to find models. And in that, the models are more robust. They're able to defend their models better. And from that, we see a much more robust analysis of credit losses.
So next on our list, Catherine Mueller.
Hey, good morning, everyone. Can you hear me?
Oh, Catherine, you're on mute.
From my computer,
There we go.
it's
We can
you're
hear
good
you now.
Okay, great.
Yes.
Good morning, everybody. I apologize I can't be there in person, but thank you for letting us dial in. So I would say a couple things that we've noticed, and again, I'm at KBW, so we're a sell side analyst covering banks, and so we've been at the front seat of this from an investing standpoint, and talked to a lot of the preparers and the investors that have been impacted by CECL. And a couple of things that I've noticed that have been positive. I'd say one, the prior method was very backwards looking, and this has been very forward looking. So it's been a benefit, I think, to have had banks that have had flexibility when they've seen macro shifts or specific shifts in their portfolios to have more flexibility to increase reserves in a forward-looking manner. So I think just conceptually that's been a big positive, and we've seen a number of moments throughout, COVID, and then through interest rate volatility, tariff volatility, a lot of swings in commercial real estate. We've seen specific banks that have taken advantage of that, and it's been good. So we've seen higher levels of reserves in periods of stress, which I think has been a big positive. We changed the rules on the double count under purchase financial assets. We've had a few banks that have announced deals early in 26, and let me tell you, it is really helped and made the analysis around M&A much cleaner. So thank you for making that change. I do think there's still some pros and cons to it. There's still some challenges, but it's much cleaner when you're just looking at an entire acquired book in one manner. So thank you for that. And we've already seen the benefit for that. A couple of things that I still think or not to be kind of criticized or issues with it are, it does still feel like, and I noticed this was number 24 in the comments. One thing that I do agree with, many of the preparers still use one single vendor. Moody's, it really drives a lot of these CECL assumptions. And so I do think one risk is we have an entire industry that's kind of focused on one vendor's view of GDP growth, unemployment. And so that could be kind of a risk moving forward if I think sometimes having a broader view of opinions could be helpful. And then two, from our seat, one thing that I do think can be challenging is, and we haven't really been through a real credit cycle to really know if this is working, but what we're looking for changes in reserves. And so a lot of times you'll see a big change in reserves and it's not always clear exactly where it's coming from. And a lot of times banks will attribute it to either a weightings change. We've gone more to an adverse scenario versus the baseline, or or there's a change in GDP, or there's a change in unemployment, or maybe they're making tweaks in loan type. So we generally get a good sense if there's an increase in a reserve, maybe in a specific loan category, we can see that, but we don't really know a lot of times what's driving it, because a lot of times what's driving it is a qualitative overlay, and there's not a lot of disclosure around that. So that's still one thing that I think from our seat has still been a struggle, and we have to continually ask questions to banks to better understand that. So they're just some comments that I would make from our seat. Thanks.
Sure. I'm going to, Fred, if you'd like to jump in.
Yeah, I just wanted to follow up, Catherine. Would you say it's harder or easier to forecast provisions post-CECL?
Well, it's interesting you say that. I'd say it's the same. And it's in periods, well, I'll say this, in periods of big swings in economic forecasts, it's hard because you don't know what everyone's going to do. But generally, I mean, what we've started to do is we'll look at Moody's and how Moody's has changed unemployment and GDP growth. And that's a lot of times the indicator with, are we going to see big reserve swings this quarter? And we really haven't, besides a couple of, again, 2020 and a couple of very specific moments, we really haven't seen that. And so outside of that, it's been very stable. So I don't know how much it's been tested. I think generally from our seat, we got a big jump in reserves when CECL was adopted. We get maybe big jumps when there's an M&A transaction. Sometimes you get a jump if you're applying more of a reserve to maybe an NDFI portfolio or a commercial real estate or office portfolio. But outside of that, we haven't had moments where we've seen big increase in reserves. And so our methodology now is kind of to keep it stable until we see big macro changes. And then charge-offs just kind of flow in beyond that.
Okay, Rich.
Hi, Catherine. It's Rich. Thanks for coming. Just curious, when you mentioned that when you see the changes in reserves, you often ask questions about what was driving those. Do you get good answers?
Yes, but they're it's a storytelling answer. It's a lot of times it's not specific. So the question will be, all right, we saw you increased your reserve. What is driving that? Is it qualitative? And many times the answer is we changed our scenario weightings, or we moved to a new model, or we went from a national unemployment number and we went to more of a regional unemployment number. So it's things like that.
Okay.
And so that's generally the answer we get, which is actually fine. I mean, I like the flexibility, but we're looking for what is making you more nervous about your potential credit loss. Like that's ultimately what we're trying to figure out. And so that's why that piece is really important just for us to understand.
Great. Thank you.
Mm-hmm.
At the top of my list is Doug, but do you want me to come back to you later, Doug? Because I see other people with their names up that might relate to this conversation. Or do you?
Yeah, I mean, if people had touchdowns or I had comments that are slightly different directions. So if others want to continue this down the path of this conversation, I'm fine to come back to me.
Perfect. Okay. Then I'll go to Mike Gillette.
From a community bank perspective, as we go from the change of incurred to CECL, and the community bank portfolios are mainly into commercial real estate, C&I, commercial and industrial, and then there's a decent portion that have about a third or so in their portfolios in residential mortgage. The change to CECL from a numbers perspective really didn't do much. There wasn't much difference, which indicates that whether they were trying to or not, they were kind of operating in practice within more of an expected loss kind of concept, we'll say. And I think that's a big reason why when we get to the costs next, I think there's a lot of concern there that the benefits of a different process or different analysis or whatever just aren't there, but the costs are. So.
Graham, you're next on my list.
Thanks, Alex. I was reminded, speaking of the 10-year anniversary, I was reminded during some of Catherine's comments about, I think, our very first TRG meeting. I think Hal Schroeder said, everyone here agrees that the cost of CECL is comparability, right? That's something we're sacrificing here. I was just reminiscing on Hal's remarks here, these 10 years later, that yep, still a challenge. Comparability is still something we're struggling with. I think one thing, and Mike, you kind of hinted at this, that maybe while we're in the topic of financial institutions, sort of the medium to lower size financial institution might not have seen a ton of change in the number. But I think one thing that undoubtedly changed is the sophistication in their modeling approaches and their approach to measurement. And so when we think about sort of the benefits and the information quality, I think there's no doubt that the switch to CECL really professionalized. The old model was a FAS 5 model that had accreted practices since the 1960s. And it was oftentimes very, very simplistic, even for reasonably sized financial institutions. I think there's no doubt that the move to CECL forced a more data-based, well-controlled, highly structured process. And I think that in and of itself is an information benefit to users. I don't want, even though that might be harder to suss out and users might not see it directly on the financial statements, I think that's an undoubted truth that should probably be remembered.
All right, Doug, I'm coming back to you.
Yeah, my comments are fairly similar to Graham's from a private company perspective. I am the one sort of private company representative in the room, as well as maybe the non-financial institutions. So I think when I looked at CECL to begin with, I think one of my concerns was this is very clearly applicable to financial institutions. But I think it was a challenge for many private companies to maybe see how, or particularly private companies that were not financial institutions, to see the sort of applicability of CECL to their financial instruments, trade receivables, contract assets, and the like. And so I think one of the benefits of CECL by bringing a single model to assessing credit risk sort of forced people to relook at their financial assets in a way that maybe they hadn't before. So it sort of forced you to look at your portfolios of receivables, and people had been applying aging models for sort of years, but hadn't really thought about things like collectability and macroeconomic factors and other things that address that. And so I think and I think it goes to maybe Graham's comments about sort of sophistication and better information for users of the financials. Oftentimes the reserves weren't changing a lot, but the sophistication of the companies looking at those portfolios of assets, it forced you to be a little bit more rigorous in your approach. And so I think that is a benefit. I think it's a benefit for a lot of standard setting that doesn't maybe completely overhaul the number that you're reporting, but it sort of changes the way that you're sort of getting to that end number. I do think is a benefit to the overall system. And I also like with CECL getting to that sort of common model for all sort of financial assets. I think the risk is, this is just applicable for loans or held to maturity debt securities, but for trade receivables and contract assets, we're going to apply something different. So I think coming to a single model was a benefit. I do have a question, though. In the benefits section, and I believe, let me reference it's paragraph 22 that talks about investors recognizing that there's more information under CECL, but we're disappointed in the nature of the information being disclosed. So not being a financial institution, my understanding is that historically under the incurred loss model, preparers were just using historical information to come up with their loss estimates, and it was putting the emphasis on the banks and the lenders to then figure out the expected loss, and that was putting the cost on the sort of users of the financials. Well, now we've shifted that burden to the preparers to do those modeling and estimates. However, it seems, and this is where I'd be curious to get some feedback, that the disclosures are lacking and thus the benefits aren't fully there. And so if I'm a user and now I'm recognizing that my preparer has built in those expected losses and macroeconomic factors, but I'm not surprised. I'm a preparer of the financial statements. I'm not going to disclose all the quantitative calculations I did potentially. I may give a high level disclosure potentially of the model that I used, but it seems like from what I'm reading is that if the disclosures aren't robust enough, then are the users of the financial statements still having to incur the costs to estimate expected losses because they're not getting all the information from the preparers? And that feels like a cost related question, but I'm asking it in the benefit section because one of the purported benefits of CECL is that the cost to users is lower as a result of CECL. And I'm just trying to decipher whether we really feel like that cost is lower for users to have to do their own kind of modeling to get to that expected loss.
Okay, I'll just quickly ask Dan to give some context to that specific paragraph you're asking about, and then if anybody else has any additional commentary.
Yeah, I would just add, Doug, that paragraph is referring broadly to like Catherine's earlier comments on the disclosures, talking about the the lack of specificity in terms of like the scenarios being disclosed when there's narrative disclosure of like what's driving the period over period changes. And there's broadly references to, we shift it more to the downside or, whatever. The feedback that we've gotten is that that's not specific enough for investors to really understand what the, what the change is. And perhaps it's to model it themselves, but it wasn't meant to be that granular of a comment.
Okay, Mike.
Yeah, I'd like to just push back a little bit on that on the comment you made, Graham, about the sophistication or whatever. For the majority of banks, at least through the last few years, the qualitative adjustments to their initial modeled results is greater than half of what the allowance is. So to try to see that it's becoming a better model or not, I'm not convinced of that. And I think there's, and I think that kind of comes with Catherine's concern that, okay, well, what are those qualitative adjustments? And they don't really often tie, or they probably normally don't tie very well to specific calculations or metrics and things like that. So there's a challenge there in trying to figure out whether it's really better information or not.
Okay, Chris.
Main Street Bank is a $1.6 billion mutual institution. Our only source of capital is retained earnings. As such, we don't have any investors. We don't have many people looking at our financial statements. The primary user of those statements are the regulators, the FDIC and the Massachusetts Division of Banks. Over the past 4 years, the primary look, as far as they're concerned, is around process, model governance, accuracy of data. I have found very little decision making or decision impact from an exam perspective against what the actual number is. All of the work we do primarily is around producing the number and the documentation for a wide variety of stakeholders. I haven't found a decision that got made or produced or pushed forward against what that reserve is. That time is spent on producing it.
All right, looks like I've gone through the queue. Any additional? Oh, Amanda.
Maybe I'll add on to what was just shared from a supervisory perspective. I think some of that could depend on the risk in the institution and the size of the institution. I have found in our experience that CECL has provided us with an opportunity to see more detail and have more in-depth conversations with bank management to really understand some of those assumptions and changes and why things are ending up in a certain manner. Now, I know the public doesn't have access to all of that information in just the financial statements and disclosures, but it has been beneficial from a supervisory perspective to be able to have that insight and to challenge that a little bit and better understand those assumptions.
Great, thank you. Brett?
I think the other observation I make around the benefits is that I know we're sitting here, 6 years into implementation, but we still haven't experienced over that time a period of significant actual charge-offs and actual realization of credit losses. So I think we haven't actually still had the benefit of seeing this operate through an entire cycle and seeing how both companies, investors, where you can kind of measure like were the reserves built earlier than they might have been otherwise, and is that well understood how we go through the loss cycle from recognition to actual realization. So I think some of this will be interesting to see how it continues to play out as we start to see this in practice over a longer period of time.
Great, thank you. Jay?
Good morning. To echo several of the comments I think that have already been made thematically, I think from the perspective of an approximate $550 billion institution, we would agree and acknowledge CECL is timelier in responding to changing economic conditions and forecast, and in that regard, addresses the relevancy-based, criticism of the prior incurred loss model with regards to timeliness. As has been referenced already, at the same time, CECL requires greater judgment, introduces model complexity that may not be transparent to users, and has made comparability more challenging, not as a surprise, but just as really a logical outcome to both the flexibility and the inherent uncertainty in leveraging forward-looking forecasts. So in that regard, it's not yet clear, I think we would suggest, as to whether CECL faithfully represents actual credit losses, notwithstanding the timeliness benefit, with various economic events that have occurred on either a little bit longer or shorter term basis since its effective date, resulting in provision build, but then subsequent provision releases. We'd also observe that the reliance of the models on the historical data that's used to train the models, as well as historical relationships, also necessitates qualitative reserves for economic activities that are not yet reflected in the historical data, which really have arisen on a recurring basis at different economic inflection points since the effective date. In steady state environments, we would suggest changes in the allowance are often driven by portfolio growth or runoff or updates to macroeconomic forecasts rather than borrower level credit migration. As a result, the allowance balance itself can be less informative in isolation, with decision usefulness perhaps shifting more toward disclosure and management context. And then CECL also introduces cyclicality primarily through forecast sensitivity, with volatility more pronounced when economic changes rapidly, whereas in more typical quarters, allowance movements tend to align with loan growth and forecast updates.
Okay, thank you for that. So next on the list, Mike.
Thanks. I promise I won't hog the mic that much here. I did want to kind of piggyback on what Brett was saying. I think that in regards to the issue of going through the downside of a cycle, and that I think once we got out of COVID, there were a couple of studies that were done that said, yeah, CECL was doing its job, and I think they missed the point, basically. I can get into some detail, and we wrote a blog post about it. But, again, I think we have to, we won't know until we really go through that down part of the cycle.
Mark, you're next.
Yeah, I want to note just a few basic things that I think need to go on the record about this and the a few benefits. I'd start with it accomplished the board's objective of changing the allowance to a best estimate of future expected credit losses. There was a story at the time. Obviously, I heard it secondhand from staff and board members about bankers coming in and meeting with the FASB and saying, and I think this is referred to in the meeting materials as well, saying that they weren't able to record the credit losses that they were actually expecting in the future. So, I think that did change that. And one of the benefits of that, which is important for an estimate like this, is the ability to backtest the estimate, right? When your estimate is the credit losses you expect, it gives you the ability to then compare the actual credit losses to the credit losses that you had modeled. So, I know folks are going to point out all the limitations with that, some of which have been circumstantial with things going on in the economy that has rendered that backtesting, less useful in this environment. But it still, I think, is an important benefit of CECL that I think is going to be even more helpful maybe as things become a little bit more predictable, hopefully at some point stabilize from macroeconomic perspective. But I think that's a big benefit. The concept is much clearer than the concept of an incurred loss. And so I think that's a benefit. More guidance was needed. And although there are options that lead to diversity in practice because there are options, it still is a more structured framework that helps to facilitate our financial statement audits of a very important estimate. So I just wanted to get those things on the record.
Great, thank you for that. John?
Yeah, maybe to piggyback off something that Graham said too, and this is consistent, I think, with Mark as well. CECL didn't really prescribe a specific model, right? That was something that was very important, was that it really was just a principle. And so I think it's there are definitely improved processes and improved rigor around how companies are coming up with their allowances. But I think it's going to be hard to please everybody with maybe, this lack of comparability with disclosures and how changing this input this much might change the allowance, X amount in that. And this kind of touches on what Mike said too, like, you could talk about inputs going into the model, but we have this quantitative and qualitative aspects. And so sometimes a factor is built into the data going into the model, and sometimes it's on top of the model. And so we're never going to be able to, unless you had prescribed one specific way to do this for everybody to do it the same way, you're not going to be able to do that. Does that mean we can't possibly improve some of the information and disclosures? No, I think there is more rigor around the number on the balance sheet. I think that, helps with rigor on what's hitting the income statement as well. But I don't think you're going to be able to please. I don't think the benefits that people are expecting that they can just take this information from different banks and be able to figure out how, their inputs are going into the model and how to compare and maybe even shock them. I don't think you're going to be able to do that.
All right, Mike, I guess you're up.
Yeah, from a comparability perspective, the industry through the call reports has probably an unequaled amount of information that people can compare to. They don't have to compare to averages, and you can tell from different, where your peers are geographically and within certain, we'll say, ranges of percentiles. I think that there's a lot more comparability than I think it's given to, just because of the way that call reporting information is available to the public.
Okay, great. Thank you for that. Brett, Graham.
Thanks,
I can
Alex.
see from here.
Maybe one thing I thought, Mark, John, your comments were really helpful, because I think one thing we might want to keep in mind as we're having today's discussion is to what, no pun intended, to what standard are we holding CECL? I think, Mark, you did a nice job of reminding people what the FRAG, the FCAG, that's what it was called, the Financial Crisis Advisory Group. That's what FRAG's the European thing, sorry, what problem were they trying to solve, right? They were trying to solve an inability to include forward-looking information in the estimate. Check. They were trying to solve 19,000 different impairment models for financial instruments. Check-ish to some degree. But there's something that they weren't trying to solve, which actually I thought Fred's question to Catherine was really insightful about, which is Fred's question was, hey, how is it easier or harder to predict provisions? And her answer is great. I don't know, about the same. Which is, this is always going to be an estimate with a high degree of estimation uncertainty. And so there's always going to be complexity in judgment. And so even when I think to Brett's comments about, we haven't quite gone through a whole cycle, even when we have that opportunity, just because there's a difference between the expected credit losses and the actual credit losses experienced, doesn't mean that's a flaw in the estimate. That's inherent in an estimate. So just think maybe we ought to keep that in mind as we're having this discussion, that a high degree of estimation precision is not said differently, there is inherently a high degree of estimation imprecision in an estimate like this because we are attempting to look far in the future.
Great, thank you for that. Looks like we've gone through the queue. Before moving on to topic 2, do any board members have any follow-up questions on anything we heard? Otherwise, Fred?
Just to follow up to Mike. Mike, I got the sense from your statement earlier that while we don't have comparability in the reserves and how companies got there to compare, your statement was that we do have a lot of comparisons for users in terms of credit metrics on the portfolios.
Well, also
To make
where
comparisons.
right, you can kind of triangulate between individual banks and kind of the rest of the industry. Where do you fall in based on like whatever your cohort might be? But yeah, it's kind of comparing call report information with specific allowance coverage along with your peer basis. Yeah. At least that's the way I kind of see it.
Because I've kind of felt when we look at the disclosure issue, which we really haven't dealt with, is that I think the vintage tables plus the call reports give a lot of insight into comparing portfolios across institutions, which I think is your point. The information's there. Comparing how reserves are calculated and provisions are calculated is something that isn't terribly clear to users. So.
Right. Chris?
Yeah, Fred, I just wanted to comment on the comparability. I think one of the things that everybody's going to have a different number, but the one thing that we're able to do is when it gets to the end of the quarter and we're comparing ourselves against our peers, you can drive into the assumptions, your point, the portfolios, and the different things that drive everybody else's number, and you do triangulate and you do. So I think one of the things that CECL has done, while it allows everybody to have a different number, I do think there is the ability, just because of the amount of inputs and different things that are now disclosed, even like how you're looking at the future versus how somebody else is looking at the future, that you can really see what's driving it. And to your point about predicting, right? Everybody's going to predict something different. Like I might think something's great, you're going to say something's bad. But I think if you go into what the KDW person was talking about, being able to predict, it's about the same. It's because everybody predicts the same, but they have now more information. So before, you wouldn't have had information of how we're thinking about the future. Maybe you would have through like something else, but now we come out and explain how we're thinking about the future with our allowance. So I think that's been a huge benefit, both from a cost to a user and even when you're trying to figure out how you're comparing against your peers.
Great. Thank you for that, Chris. Mike?
Yeah. And one thing that came before CECL, but after the crisis, was kind of breaking things out, breaking portfolios out by, how you estimate your losses. I think that's helped get that comparability. And that similar breakout exists in a little different form in regards to the call reports, where allowance coverage can be calculated based on whatever the 6 loan types and such like that. So those aren't necessarily CECL things, but they certainly have gained a lot more prominence over the last several years.
Okay, thank you. All right, last call for topic 1. Oh, Hillary?
Maybe just from an overall perspective, obviously we've heard discussion about non-comparability, but it also sounds like what I'm hearing from a benefit perspective is that the fact that CECL didn't provide a single model that had to be applied, that there was an ability to apply judgment, we weren't prescriptive about that is in and of itself. It sounded to me like for many people that's a benefit of the standard, right? That it's not overly prescriptive, that it does allow judgment. Not that there aren't costs associated with that when there's significant management judgment, but just wanted to kind of formalize and ask that question from a preparer perspective of, was that a benefit when we think about more principles-based standards versus more, prescriptive standards? And that's more of kind of thinking about things overall from a standard setting perspective going forward as well. I'd be curious.
Mike, is that you? Okay.
For community bankers, a lot of them, especially if they're associated with one particular software company, is doing kind of a revised sort of warm kind of thing, but with the total intent to, as the more experience gets and more data is collected, that they would migrate to a different method as they deem fit. I don't know how much those conversations are, how mature those conversations are. Like, are people going, yeah, no, not yet next year, or no, not yet in 5 years, or what have you it is. But that certainly is the intent. So I think the flexibility, was something that came in handy, at least.
Chris.
From a preparer perspective, that optionality creates a lot of extra costs. We found ourselves in a position early on where we would not have the loss data to support some of the more complicated models. But as the years have gone on, you would expect that we would have that data and be able to use it. However, excluding the COVID experience, for example, and the lack of losses over the past 8 years, we still want to rely on a model that relies less on our actual loss history. However, we are asked by various stakeholders, whether it be our regulators, our outsourced internal audit, and our audit exam for our financials, about, have we thought, or have we reconsidered, have we looked at these models again, and are you still sure you've made the correct choice for where you are today? Quite frankly, it took a lot to stand up what we do now at a much, we'll get to the cost, a much higher cost than we expected. So looking back, or looking around, or revisiting, and then thinking about what that would mean to then meet all of those stakeholders' expectations again, is very difficult and not particularly productive.
Chris, I think you're next in the queue.
Okay, thanks. I think Hillary, actually, it's spot on. The not having to fit a round peg in a square hole is fantastic, right? Everybody has a different set of loans. Everybody has a different book. Everybody manages them differently, both from underwriting, rating, to the overall management. So if you have the ability to develop a model that aligns better with how you manage, is going to be way better than just having a prescriptive model. So I think from our perspective, that being able to do that was a huge benefit versus being told, just do it this way. I think you would have gotten way different results, and more difficult for people to, at least when you're talking to analysts, to explain why your book's moving in a certain direction or not.
Great, thanks. Brett?
Appreciating the complexity that a lot of these models have, and maybe building on something Chris said, I think we have observed, especially for larger institutions that are balancing capital management, stress testing, risk management, and this accounting treatment for CECL. I think that there was an opportunity, and people did see some benefits of being able to triangulate models and processes that could satisfy all of those. And I think having that flexibility was a key part of that. If you had to do something very prescriptive for accounting purposes that wasn't necessarily used for these other purposes, we could have actually had maybe greater costs and more complicated processes than we actually saw.
Great, thanks, Brett. Catherine Miller?
Just one thing I wanted to follow up on from Fred's original comment or question to me about what has changed and how we model it. And this is I was thinking about this after some of the other comments that came up earlier, is one thing that I do think that is different now is, when we would start to see credit stress in the industry, one thing that we would do is we would increase our estimates for reserves and net charge-offs at the same time, which of course is a bigger detriment to your earnings stream. And I think what I've noticed more recently under CECL is when we start to see moments or pockets of credit stress, we increase reserves immediately, or we stop the release of reserves immediately, and then kind of can figure out the flow of charge-offs later. And so I think actually what it's done I'm going to change my answer a little bit to Fred's question, is I think it's made our ability to forecast reserve builds a little bit easier and earlier. And still, the estimate of net charge-offs is ultimately the hardest thing. And that's where all the judgment and estimates actually come from. But I do think it's given us more flexibility and ability to increase reserve builds at a quicker, more appropriate pace, which is exactly what we want to be able to do. And we have seen moments where we have done that.
Great, thank you for that. JP?
Yeah, thanks. Hillary, to your point, I do think one of the benefits of kind of the flexibility in the standard, especially in the community bank space, is that flexibility. To Chris's point, especially in the community bank space, the stakeholders can be very different. The primary stakeholders can be very different. Chris's bank has very different stakeholders than maybe a comparable bank that's even right down the street that may have, a public company have different stakeholders, different users, and the flexibility that's provided with how CECL was deployed certainly accomplishes, that helps. That's a benefit.
Great, thank you for that. So that we can stay on schedule, I was going to pivot to topic 2, unless anybody has any pressing things to say on topic 1. Okay. I'll have Mike tee up the next topic.
Thanks, Alex. The next topic we would like to cover today is the costs associated with implementing and applying CECL in practice. When the board issued the update, it acknowledged that entities would incur costs to gather data, develop estimation methodologies, and implement new processes and controls. At the same time, the board sought to minimize those costs by allowing flexibility in estimation approaches, leveraging existing credit risk management systems, and avoiding prescriptive modeling requirements. As part of the PIR process, the staff has gathered feedback from a wide range of stakeholders on both implementation costs and ongoing application costs. Overall, stakeholders have indicated that they were generally prepared to adopt CECL. However, many noted that implementation required significant time and effort, particularly in areas such as data validation, model development and validation, and process changes. Some institutions also observed that costs exceeded original expectations, including unanticipated expenses related to economic forecasting and third-party vendors. Feedback has also highlighted ongoing costs associated with applying CECL, including maintaining models, responding to stakeholder scrutiny over assumptions and qualitative adjustments, and developing disclosures that are responsive to investor expectations. Today's discussion is intended to further inform the board's understanding of both the magnitude and nature of those costs and how they compare to expectations at the time CECL was issued. With that, we'd like to start by hearing your perspectives on costs incurred to implement and ongoing costs to apply CECL, and how those costs compared to your expectations and have evolved over time.
Great, thank you, Mike. So we have 3 questions for topic 2 on costs, which are on page 12 of the meeting materials. Vice Chair Bowman, would you like to kick off the discussion on this?
Great. Well, thank you so much for allowing me to be a part of your roundtable this morning. And good morning to everyone who's here. Thank you for hosting a discussion on this important topic. CECL has long been a controversial topic among both bankers and bank regulators, especially the state bank commissioners during its consideration and its lengthy implementation time. My perspective on CECL has been formed over many years through direct experience, both as a banker, as a state bank commissioner, and as a governor at the Federal Reserve overseeing banks below $50 billion in assets for the Federal Reserve, and now as the vice chair for supervision at the Federal Reserve Board. My role at the board began in 2018 with the oversight of banking, especially for small banks. I've long been opposed to this overly complex and unreasonably burdensome standard that provides extremely limited, if any, benefit in comparison to the prior incurred loss standard. From my perspective at the board, I have seen firsthand how this standard impacts institutions of all sizes, but particularly community and smaller banks. I have shared these concerns about cost and complexity with FASB over the years and asking for a wholesale abandonment of CECL, or at the very least, practical consideration to make adjustments that would ease this unreasonable burden on community banks. I requested to be a part of this roundtable today because CECL has failed to deliver on what was envisioned in its creation. There is clear evidence that CECL has imposed significant costs while its anticipated benefits have not materialized. The methodology has introduced significant model complexity, procyclicality, volatility in outcomes, validation burdens, and vendor dependencies. Yet we have not seen corresponding improvements in loss recognition, risk management, or financial stability. Community banks would be better served by returning to the incurred loss standard, and I urge the repeal of or the exemption from CECL for smaller banks. The incurred loss methodology was well understood. It was cost effective, and it produced substantially similar results to the current allowance methodology without the need to manipulate the underlying data to meet accountant expectations and disproportionate burden that CECL imposes on smaller institutions. For community bankers, it was a practical approach that worked effectively for decades. For the benefit of time, I will limit my critique to 5 significant concerns about the CECL accounting standard. First, high cost, same or less reliable results. Community bank reserves increased just 5% on average after CECL adoption. More than half saw no change at all. Capital ratios were essentially unchanged. Less than 10% of banks used the transition relief we offered. When banks voluntarily forego regulatory relief, that in and of itself is evidence that underlying change was not helpful. Yet community banks are spending hundreds of thousands of dollars annually on vendor models, validation, systems, data infrastructure, and consultants. Smaller institutions spend up to hundreds of thousands of dollars annually just on third-party vendor models. Some of these costs are fixed, regardless of bank size, meaning that they disproportionately impact smaller banks. And I asked for one particular institution's costs affected that were associated with just the implementation. The total was $475,000. So that included $130,000 for additional staff hired to do CECL, $170,000 to finance that staff over 2 years of the effort, $45,000 for third-party implementation services, $55,000 for the model software, $75,000 for model validation. That's just with the implementation. The ongoing effort with the finance staff is $65,000 a year. Ongoing model monitoring by a third party is $55,000. Third-party software, $65,000, and model validation, which is required every 3 years by policy, is $75,000. That's $260,000 of ongoing annual implementation costs. It just, they're to the benefit when they were implementing the incurred loss model, they used an Excel spreadsheet. It took 2 hours or 10 hours per quarter to implement it, and they were able to do it in-house without any external validation or additional hiring of auditing standards. So I wanted to talk a little bit about the fact that since CECL produces virtually the same reserves at a considerably higher cost, it clearly has not improved safety and soundness. It is a costly accounting exercise that has failed to enhance risk management or financial stability. So the second point I want to bring up is it's a vendor compliance trap. CECL's lifetime loss forecasting requirements have led many community banks into third-party vendor dependency, creating black box models, reducing institutional knowledge, and the ongoing validation costs layered on top of the model costs. Despite these investments, community banks still rely heavily on management judgment for more than half of their reserve determination, similar to the incurred loss methodology. They're using expensive models and then adjusting them with the same judgment-based assessments, but now with the massive validation and documentation overhead. The third point is that it's an unjustifiable burden. Community bankers tell me we're taking a more expensive route to the same destination. Nothing changed except the checks we write to our vendors. We're paying for sophisticated models that our auditors then question anyway. CECL requires extensive documentation for validation and qualitative factors. Peer comparisons are nearly impossible under CECL due to institution-specific models and adjustments, yet community bankers still face pressure and added costs to explain variances. The fourth issue is increased procyclicality. During downturns, forward-looking models require immediate recognition of lifetime losses, forcing rapid reserve building when earnings are under pressure. Banks must restrict lending precisely when credit is most needed. During expansions, models reflect benign conditions and reserves decline relative to portfolio size, potentially encouraging excessive risk-taking when the system should be building resilience. Fifth, and my final point, is that capital is the better tool for managing potential losses. Reserves should reflect expected losses based on current information. Capital should absorb unexpected losses and model uncertainty. CECL conflates these concepts by forcing lifetime expected losses into current reserves, creating volatile and procyclical outcomes. The correct approach would be to permit smaller banks to return to the incurred loss for reserve calculations, which is simpler, it's well understood, and it is essentially cost-free. The same bank that shared that prior model was shared that their prior model was an Excel spreadsheet at no cost, and it was 10 hours for their CFO each quarter to administer that loss model. We should also set the correct approach would also be to set capital requirements at levels that provide adequate buffers for unexpected losses. This approach is more transparent, it's more flexible, it's more stable across economic cycles, and it's better aligned with the economic substance of credit risk. So we urge FASB partnerships to first repeal or exempt CECL for small banks. Given clear evidence of its large costs for no additional benefits. Also, acknowledge implementation has failed to meet expectations. It has not improved loss recognition or enhanced risk management, and it has imposed unjustifiable costs, especially for smaller institutions. As an interim measure, while CECL is being considered or revised or repealed, create an exemption for community and small banks to return to the incurred loss model, or at a minimum, expand practical expedience to community bank loan portfolios. I want to thank you very much for the opportunity to share the Federal Reserve's direct regulatory and supervisory observations with you. The feedback from this roundtable is of the highest importance, particularly as we work to ensure appropriate treatment for small and community banks as they continue to prioritize challenges to their business model. I look forward to hearing your perspectives at this roundtable today, and thank you again for allowing me to participate.
Great, and thank you for taking the time to join us to provide the feedback. We appreciate it. Is there anybody in the room who would like to add some commentary? Mike?
Yeah, thank you. We certainly appreciate and agree with Governor Bowman's efforts to, we need to really drastically cut the costs. We want to make sure that there aren't any unintended consequences depending on the path that we take. But it is a general path that we know that we need to go into. I think this post-implementation review process actually kind of brings us to a kind of a crossroads moment because of these costs. And of course, as Governor Bowman has mentioned, I think we can actually, if we kind of get our heads together, we actually can get some sort of agreed upon practice that would require, agreement with auditors, auditing standards, companies, or organizations, and that would dramatically, decrease the costs and even be more transparent to users for that matter. I'm confident we can do this. I hope this roundtable is, just the first step. But, I think that one of the things that Graham, you brought up is, this kind of inherent subjectivity, uncertainty, and stuff like that. The standard itself talks about, it's scalable, open like that. But with this inherent subject, is there a possibility of getting a non-complex model when you have to be audited as though it were complex because of that inherent subjectivity and such like that? That's the kind of question that we really need to address here. And I'm sure many people will have this might turn into a free-for-all of discussion. So appreciate hearing other people's thoughts.
Great, thank you for that. Chris?
From a credit union perspective, we see parallels. Yes, credit unions reach out to us and ask for an exemption, and we support that. But we also recommend that FASB continue to work with the Private Company Council to develop more practical expedients to reduce the burden to smaller credit unions. Cost-wise, cost-wise, we've seen the cost as a percentage of professional fees as a percent of assets be more impactful on smaller credit unions than larger credit unions. Although we don't have direct insight into the drivers of these costs, we did see it go down before CECL and go up, and it's continuing up. Thank you.
Great, thanks, Chris. Let's bring in the investor perspective. Catherine, I see you have your hand up.
Thank you. I would offer a couple of things. I agree very much with Governor Bowman on the cost. I think we talked a lot earlier about how we're kind of coming up with the same reserve estimates, but all of a sudden we've added a lot more complexity and a lot more cost to coming up to the same answer. And so I very much so agree. What I would hope that we could change would be to simplify the methodology, to take less steps out of all the risk validation models and all of that have been established under CECL. But what I like about CECL still versus the incurred loss model is that it is forward-looking versus backwards-looking. I think that was something that I think that was a detriment to the industry under that model. And so that piece I like. It's just, is there a way to do that without making it so complicated and so model heavy where we're spending so much money to get to the same place? I would also, and one thing, Governor Bowman, that you mentioned is is on the smaller banks. If they could have maybe go back to the incurred loss model, which maybe would be different than the large banks. I do think having two methodologies could be more complicated from an investor perspective, and you lose a little bit of comparability across the industry. So I would argue keeping the same methodology for all banks. But again, I really do agree with everyone that has said there has got to be a way to make this methodology less costly than it is today. And I think that I would argue should be a big focus for this committee. Thanks.
Great, thank you for that. Vice Chair Bowman?
Thank you. And thank you, Catherine, for that, for those comments and for everyone else for their perspectives so far. I would say just one thing, having been a community banker and a loan officer, you don't think about the fact that the loan that you're making today is going to create losses for you going forward, or you wouldn't make that loan. So that, I think, in and of itself is just underpins the, I don't want to say ridiculous nature of CECL, but I was a banker when this was envisioned, and then a state bank commissioner, and it's pretty clear that whoever created this doesn't understand the nature of lending and underwriting, especially from a small bank perspective. So I do appreciate that forward looking is great, but when a bank has other things to rely on that come up with the same answers that CECL provides, allegedly looking forward, it clearly isn't delivering the benefits that it was expected to deliver. I think one of the other challenges that I see is that it's hard, I think, to separate the idea of this ongoing cost and having a conversation that involves people who rely on those ongoing costs to facilitate a standard. I mean, that's challenging for me to separate those who benefit from implementing a standard like this that really doesn't create a discernible benefit from the actual nature of the lending within banks and that expectation of what it's going to value. I would also say that the banks that are suffering the most under this are well under $1 billion in assets, because the most banks that we have in our system of 4,400 banks are below $1 billion. So most of those banks are not publicly traded, yet they're subject to the same standard.
Great. Thank you for that. Mike, you're next on the list.
Yeah, I think we have to remember that back in the 2005, 2007 timeframe, much of the audit emphasis and resulting documentation emphasis on the loan loss reserve back then was to avoid earnings management. And so there was a lot of push trying to justify that you weren't too high in your allowance back then. But the point that Governor Bowman brings up on and this is in response to you, Catherine. Hi, I'm good to see you. So anyway, but the point of the forward look, community bankers were doing that anyway, in particular because their portfolios were heavy in the C&I and the CRE space. They can't say that their models were saying, yes, we go to the end the life. However, that's kind of how they looked, especially in the risk rating and loan review process. And so I don't think that you're going to miss a forward look, we'll say. I think that's just inherent in the community banking business. Thank you.
Thank you for that, Mike. Chris, you're next on the list.
I would like to echo a lot of the comments around cost from Governor Bowman. The implementation costs were much more than we expected, and the ongoing third-party vendor costs are more than we expected by, in some cases, a wide margin. My prior institution was a bank that was below the $1 billion threshold. We entered into vendor contracts to clean up our data, roll up a governance structure that would work, and then choose models. We worked with them for a year to organize the data. We ran parallel runs for about a year. And then in the third year, as the timetable got expanded and things were pushed off, and the Fed's tool, CECL scale, was introduced, we ended up scrapping all of that work and putting it aside. And I don't remember the dollars involved, but I do remember a board member at the time saying it was essentially equivalent to the capital needed to support 10 low-income 1 to 4 family loans. Again, as a community bank, as a mutual, retained earnings is our capital. So we can draw a direct line to cost or cost savings to the capital we have to support the community. At my existing institution, when I got there, they had already developed a model and entered into third-party contracts. And at every turn, every stakeholder, outsourced internal audit, external audit, regulatory, whether that be the state or the FDIC, there is always a best practice or something more or a lesson learned from a third party, 2 or 3 entities removed, that adds complexity to what we're doing from a documentation standpoint or a governance standpoint. Looking back 12 months in preparation for this, I took a look at what our hard cost third-party costs were, and then compared that to our gross charge-offs. Over the past 12 months, our hard costs exceeded our gross charge-offs. And that's the kind of scale disparity you get at the smaller institutions. Looking back for a whole 3 years, our hard costs are 80% of our gross charge-offs. It is simple. The cost, there's no benefit to the costs. If I could simply put aside that work and fund the gross charge-offs before recoveries. Thank you.
All right, thank you for that feedback. Rich, you're next in the queue.
Yeah, no, I just wanted to thank everybody for the comments. I think one thing that I certainly clearly hear as part of this process is targeting ways to remove costs from the systems for some subset of the population. Applying this standard certainly makes sense. You know, one of the things that we run as a challenge, and I think Catherine kind of alluded to it, is multiple models. And sometimes it can be totally different models. Sometimes it can be simply practical expedients to make models simpler. But I'm also hearing, I think, from a regulatory perspective, a willingness to regulate under multiple models, which might be something slightly different than we had heard in the past. So I think that's something interesting. The other point that I want to mention is what I'm also hearing is the cost may not be solely accounting driven cost, that there may be regulatory and audit costs that are also driving that. And does it really make sense? And I think it was in the ABA suggestion to look at those comprehensively to make sure that we're really addressing root cause and potential solutions that will actually work through the system. Because I do wonder sometimes, even under the incurred loss model, which I did have the opportunity to apply for a long period of time, and I think as Graham mentioned, large portions of the incurred loss model weren't written down. They were applied via practice, regulation, audit, and so on. If we don't attack the costs from not just accounting, but also audit and regulatory perspective, would we simply be shifting those costs to the documentation effort around I'll call it the incurred but not reported loss under an incurred loss model? So do we need to maybe take a little more comprehensive look at this? It really is a question.
Great, thank you. Chris McGrath, you're next.
Okay. I wanted to thank the FASB for coming out with your statement on the WARM method, because that has been a great example, a good public good of a practical expedient that has helped smaller financial institutions, smaller depository institutions. Now, we're all smart people, and we should be able to figure out some practical expedients that will help our smaller depository institutions. But I have to admit that I've been hitting my head against the wall on this one. So, please reach out and let us know of anything that would be could be workable. Thanks.
Great, thank you, Chris. Next on the list, Joe Stuyven. You're on mute. There we go.
Good morning. Hope you can all
Perfect.
hear me fine. Okay, thank you.
Yes.
Just a little background. I was actually on your Investors Technical Advisory Committee from 2012 to 2015 when CECL was in the process. I was vice chair in 2014 and 15. And if you look at the letter that we wrote back then, it was a somewhat critical model, critical letter of CECL. And one of our problems, and this was taped, is that we said there was never was an honest cost benefit analysis ever done. Now, I further appeared in front of Congress in 2018 for the House Financial Services Committee regarding the CECL model. And I'm going to give you a totally different view. That's what I think they'll be a little bit more harsh. From an investor's perspective, I've been investing in banks for 40 years. Investors across the board do not like this model. Some of the best bankers in the United States, big and small, And I would say arguably maybe the best banker in the United States was Jamie Dimon. He was questioned one time about CECL, and his exact words were, "I will not even discuss this model." I had a bank in our hometown in Missouri, 175-year-old bank, tell me that they could never believe this is a bank that went through the Great Depression, the Great Financial Crisis. I won't say their name. You could probably figure it out. 40. If we say it's only billion-dollar banks, it's hurting banks way up the size spectrum. And I know Governor Bowman has already talked about it, is that remember back in 2010 when Dodd-Frank came in, there was a $10 billion limit on a lot of quote unquote asset thresholds. This nominal GDP makes that close to 25 billion. And here's another aspect nobody wants to talk about. The complexities of CECL are borne more by the small banks than the big banks. And let me explain why. You have to go through the exceptionally complicated purchase accounting process. Big banks don't have to because they can't do deals. But all the small banks who are trying to grow, trying to get scale, have to go through this exceptionally complex purchase accounting process where CECL is a huge part of their cost analysis. In addition, it is taken, and I give Rich credit, and I have talked to Rich over the years. The CECL, there was a problem in CECL that was so obvious, the investment community gave it a name called the CECL double count. And it took the FASB how many years, Rich, thank you, but to finally get this. So I think we're making a mistake if we think it's only impacting banks under $1 billion. It is dramatically impacting banks under $100 billion. It really is. And people don't want to talk about the cost. I've still never seen a cost benefit analysis that has been proper. Most banks I talk to right now say their most expensive cost is trying to justify their CECL model because their CECL model says to lower reserves. And they don't want to lower reserves. They're trying to do everything they can to not lower reserves. But CECL says to lower reserves, and these good don't want to lower reserves. So that's it for my comment. Thank you.
Great. Thank you very much for that feedback. Is anybody else interested in weighing in on this topic? Oh, Chris.
More of an observation. The more flexibility we have, it creates more insecurities and the fear of being challenged. And I think that's a bit of what's driven the cost of, credit unions, financial depository institutions are afraid of being wrong. And so therefore they go for the more complex, more robust, but they don't have guidance on, hey, what can we dial back to? What can be the balance to get to a good number without going through all the cost, all the complexity? So finding that right balance. And maybe it's kind of similar to what happened with SOX when it first came out, Sarbanes-Oxley. Corporate credit, corporations were very concerned. And a whole lot of money investment was done in Sarbanes-Oxley, in internal controls. But as we got comfortable with it, that governance continued, but the effort was able to be dialed back because we became comfortable. So I think we'll still go through the process of insecurities and trying to find that right balance and not being, and everyone's afraid of being challenged, especially if you're a small financial institution. So thank you.
Great. Thank you for that. Vice Chair Bowman. Oh, sorry, you're on mute.
Thank you. I lowered my
Okay.
hand, but forgot to take myself off.
No problem.
But thank you for that. That's a really important point that you brought up about fear of being challenged. I think the problem that we've had, especially over the last 10, 12 years of supervisory oversight is that there seems to be a lot of pendulum swinging in the way that supervisors are implementing supervisory regulations and making measurements regarding compliance with those. The problem that we have here is that this is a GAAP accounting standard. And so there is no ability to deviate from that. And you're subject then necessarily to the fact that there are pendulum swings among the way that supervisors come in from administration to oversee and measure your compliance with those requirements. Simply because it's an audit standard and it's a GAAP requirement accounting standard, that makes it impossible for banks to do something different. So it's not a supervisory issue. It's the fact that this is built into GAAP and they're required to use GAAP. If you eliminated it from that accounting standard, then I think we would have a very different environment where banks could have flexibility to do different things and be measured in different ways. Oops.
Great. Thank you for that. Graham, you're next.
Thanks, Alex. I was building on those remarks, and actually both the Chris's. I just wanted to clarify. I think I've heard in one regard, maybe there's not enough flexibility for, we're talking a lot about banks, but I suppose it's not just banks, but banks of different sizes. But I've also, I think I heard from the two Chris's that there is flexibility in the model, but there may be a fear of using the flexibility that's there. I guess I just wanted to clarify what precisely the concern was. Was it that there's insufficient flexibility, or that there is flexibility that's not being utilized?
Mike?
I can't go on. I can't get into the comments in regards to the flexibility or what have you. But I think the scalability issue is something that we really need to think about. And I mentioned a little bit on whether it's possible or not. But, throughout the industry, it was encouraged that the smaller banks would do quote unquote non-complex models. Those non-complex models result in, quite honestly, much more in regards to the qualitative network. And so the auditing perspective still treats it like a complex model. It's just not in the quantitative portion, it's in the qualitative portion. And the qualitative portions probably weren't very well set up, just because they would not be able to at a community banking level. So it's almost like we ran them into a corner. Okay, they're not going to. They're going to have these quote unquote non-complex quantitative models that they paid for and then will run quickly. But it just set them up for a lot more work on the qualitative aspect and a lot more documentation as a result. So they kind of are between the rock and the hard place on this.
Great, thank you, Mike. Chris.
Granted, there is a lot of available flexibility, but as the number of stakeholders increases, that flexibility gets tighter and tighter and tighter. We have outsourced external audit. We have our audited financials, our third party. We have our regulators, 2 of them, before I get to the holding company and add another one. And at each step, even though the work is relatively straightforward and we've stayed on the same path, every one of them has a slightly different look. And although you'd like to argue that, hey, we've got flexibility, so this report and this documentation is answering your question, it's come from a best practice or a checklist or from on high that they want to see it in a very specific way. And quite honestly, it's easier to produce what they are looking for exactly how they want it, and then do that again and again and again for each stakeholder, than it is to keep arguing the same point. When it comes to the standard itself, I've been a CFO for 9.5 years over 2 institutions. And the only management letter I've ever had as part of an audited financial package was due to CECL. And it had to do with documentation and third party and review and consideration. the flexibility has not provided any burden relief whatsoever.
Great, thank you for that. I'll pause and see if there's any final thoughts on this topic before we start our break. Sorry, I guess Joe Stiven, I guess your hand's up.
I just wanted to bring up one other point, and we had talked about this years ago, is people love to say on the incurred loss model that banks were not looking forward. And again, I've looked at banks for 44 years now. My first 3 was as the Federal Reserve Examiner. But if you look at banks under $50 billion, and this is using data from Catherine's firm, KBW, you look back, even going through the GFC back, the average bank was reserved 2 years out of net charge-offs. So to say that the incurred loss model didn't let banks look forward, again, in all practicality, I disagree. The banks were. The veteran banks absolutely were. So I'm just trying to give some perspective that these banks in general have been exceptionally well reserved. The old rule of 1.25 to 1.5. Lo and behold, here we are with CECL, and the banks are justifying to keep their numbers this high because CECL wants to push them lower, and they don't want to push them lower. So thank you.
Great, thank you for that feedback. Any final thoughts before we take a break? Oh, Mark.
Yeah, I just wanted to acknowledge, I mean, the biggest change that CECL made was going to a best estimate of expected credit losses. And I just wanted to, a couple of speakers have pointed out, the argument is to return to the incurred loss model, but several people have acknowledged that banks were not using an incurred loss model to prepare their reserves. So that to me would make it difficult to go back to an incurred loss model. It's just that they were using an expected loss model that wasn't codified in GAAP at that point. So I think I just wanted to make sure that that point was made.
Yeah.
Sure, thank you. Mike?
They might not have been you doing an incurred loss model, but I think it was the information that then they felt they required to kind of apply in the model. So there is a difference there.
Okay, Catherine?
From my memory, one thing that was a challenge with the incurred loss model, and I agree with Joe that I do still think there was a forward-looking element to that model because, again, we're all making judgment on what you think you need to prepare for the losses in your book. I mean, that's what the whole thing is. But I remember one challenge was coming out of the great financial crisis. Because of the incurred loss model, you had to keep a reserve relative to your most recent, I guess the look back was like 5 years of net charge-offs. I remember banks had to keep elevated reserves almost for an extended period of time coming out of the great financial crisis because it was so backwards looking. And if at that moment it had been more forward looking, we wouldn't have had to keep reserves that high because, again, we didn't think that there was a lot of losses, coming into the future because of what we just been through. So that was just one thing that I just wanted to bring up and point out because I do think that was a part of the conversation. We were thinking about the pros and cons versus incurred versus forward. That was one of the implications. And again, I think we all agree that I think incurred and this current model, we're all just making our best guess of what we think is appropriate for your reserve. And so I think it's just simplifying the methodology is ultimately, I think, what's going to get us all to the same page. That will improve the cost. But it's just making it's still, at the end of the day, it's still just a gut judgment call. And I love Governor Bowman's comment about capital should really be the venue for that versus, an oversized reserve. As equity analysts, we look a lot at reserves plus capital, and capital always matters probably actually more to me than reserves. So I really agree and liked that comment.
Great, that's helpful context. Thank you.
Thank you.
Graham, you're next.
Oh, this is not going to be any fun. I'm going to do something nerdy for a second. And I just want to build on Mark's point. I thought Mark made a really important point, which is, and maybe to kind of flesh out some of Catherine's remarks, I think there's a huge expectation gap between what an allowance for credit losses historically was and what the accounting rules said about it. So Rich mentioned the concept of incurred but not reported, IBNR. And that's what the incurred loss model was. So I'm going to pick on my friend John here. Let's say I own John's mortgage. And I think John's going to lose his job and default on his mortgage, but he hasn't yet lost his job. Sorry, John. Congratulations, not losing it yet. Yeah, I know. My balance sheet date comes. I think, simply speaking, the incurred loss model would say, I can't put up a reserve for John's mortgage because the loss-causing event, John losing his job, has not yet happened. What CECL allows, in theory, is when you go, I'm pretty sure John's going to get canned. I can pull that forward. Now, in practice, I think we all understand that through the accretion of norms and all sorts of practices, I'm a former bank regulator, I can say that. There was a forward-looking element there, and I don't disagree that some of that perhaps belonged in capital. But for a long time, capital wasn't the lever anyone pulled. The lever people pulled was the allowance for credit losses. So I just want to be careful. And I think, Mark, I don't want to overstep what you were saying, but I think the risk here is that now that we've all said these things, if we move to an incurred loss model, we might actually move to a real incurred loss model. And that might be a drop in the level of allowances, which might not be anticipated by some of the remarks were made here today.
Great, thank you. Mike?
Yeah, hopping on the nerdy wagon here. Yeah, I agree. It definitely was differences in practice. I think was a lot of it was due to the 2006 interagency guidance in regards to Q factors and things that you would add. I think they identified the issue actually way before the financial crisis occurred. The thought also gets complicated because back then there were thoughts about converging internationally, and the International Accounting Standard had some very tight language over visible impairment and such. So they really did have something that was incurred that wasn't, and that sometimes gets lost in this. And we think that wasn't the case here in the U.S. We were trying to build a lot more, and that's why the U.S. Reserve levels, allowance levels were something like 250% higher than the international levels. So. Again, we just want there's a lot of stuff going on when we talk about incurred. I think the key is we need to have a good dialogue to make sure everyone is on the same page on what that means, and from not only conceptually for the users, but also what that means from a documentation standpoint. Yeah.
Great, thank you, Mike. Vice Chair Bowman.
Thank you. And after my comments now, I'm going to have to drop off, but thank you again for the opportunity to join you. I do want to make a note that I also participate in the Financial Stability Board globally, and I head the Committee on Supervision and Regulation there. All of the regulators around the world are looking forward to modernizing our frameworks. So looking at an old standard and thinking that that was the right direction internationally, and trying to address things that happened in previous crises that we have more than addressed through Dodd-Frank and other regulatory approaches that are being preserved, I think is something that we need to just really keep in mind as we're thinking forward about what is the right way to approach the reservation for loss. One thing I would also like to note is that I don't think that the incurred loss model was perfect. I think all of us recognize that and have commented on the fact that maybe it didn't allow for enough reserve holding, so a lot of bankers did pad those reserve balances. But what it allowed them to do was have more flexibility to do that and to work with supervisors to ensure that they were meeting what those expectations were, instead of having a very very concrete and rigid framework that requires all of this additional cost benefit. So where there could be an opportunity to have a conversation about an enhanced or improved incurred loss model, or call it something different, but a blend of something that would reflect some of the valuable parts of thinking about CECL, but without all of the complexity of its implementation. I think that there probably is a better approach forward than just a rote return or using this model that we're working on now going forward. And I look forward to the opportunity to have some constructive conversations across industries about how we could think about that and approach that going forward. But the problem again is that this is the accounting standard and GAAP requires it.
Okay, great. And thank you for joining us. It looks like we are on schedule for our break, unless anybody has any final thoughts. No pressure. We still have plenty of dialogue to go. We're only halfway through this roundtable. So let's plan on reconvening back here at 11:55. Thank you. Oh, okay, everyone. Hi, everyone. It's 11:55. All right, let's get started. All right. All right, we're gonna get started now on topic 3. There's no glasses here. All right, we're gonna get started on topic 3 now. I'll turn it over to Dan to tee it up.
Building on the discussion of cost, the next topic today focuses on specific application challenges that were encountered in applying CECL. As part of the PIR process, stakeholders have identified a number of areas within the guidance that have been difficult to understand, operationalize, or apply consistently in practice. These issues span a range of topics, including transition, disclosures, modeling considerations, and application to specific transactions. The board has responded in a variety of ways, including standard setting, to mitigate any unexpected costs, reduce complexity, and improve comparability. The standard setting actions have included clarifications, practical expedients, and amendments to recognition and measurement guidance, all intended to better align the accounting with the underlying economics of credit losses. Through the normal course of PIR, the staff regularly solicits feedback to monitor those issues and learn about any new issues emerging as practice evolves. Understanding whether issues have been adequately addressed and whether new issues are isolated or pervasive is an important component of the PIR. To that end, we'd like to hear any feedback on the issues discussed in Appendix C of the handout, specifically whether you believe further action is necessary to address one of those issues, and whether there are any additional areas of complexity or difficulty that we should be aware of. And those are questions 7 and 8 in the handout.
Great, thanks, Dan. So as Dan mentioned, so we have 2 questions for topic 3 on page 13 of the handout. And so this topic, we get a little bit into specific issues, but I want to remind everyone this is not a TRG meeting. So the intention here is not to get deep into the weeds of technical matters and do application of GAAP to specific fact patterns, that type of thing. So let's try to keep the conversation a little bit high level, but we are curious to see if there's any perspectives on some of the various solutions or amendments that the board made after the implementation of CECL to help with the application of CECL, and if there's any lingering issues that are out there. I'll start with Doug.
I got mine up fast so I could get my easy comments out of the way before the fun starts. Yeah, I think not surprising, and this is going to kind of reference back to some of the cost discussions we had in the previous discussion here, but just for private companies, application challenges being getting through an audit, right? Documenting all the assumptions that you use, and that's going to be for your small private community banks that are really impacted by CECL due to the high level of financial assets that they have, and then for kind of everyone else that's got all their other, trade receivables and things of that nature. And so, I think sitting back a little bit in the previous discussion, really navigating through where my head was at from the preparer seat that I sit in, knowing that it is helpful to have a flexible standard in the sense that it gives you optionality in how you apply that model, and then hearing other discussion in the room about, well, hey, this, and I really appreciated the SOX analogy of when we first adopted SOX, the full pendulum swung and we documented everything to the nth degree, and we went to this extreme, application challenge to be able to, adopt initially. And then as we started learning the standard, we kind of dialed things back to a more acceptable level. I do think in many respects, when CECL came out, there was a inherent, maybe unspoken expectation for companies, and private companies being maybe disproportionately more impacted, to go through all of the documentation hurdles, even for certain financial assets that would not be heavily impacted by CECL, right? So why am I spending all this time talking about macroeconomic factors and unemployment rates when I know the end result is immaterial or unsubstantial change to my credit reserves? And so those were really where, from my seat and my perspective, the application challenges really existed, was the documentation hurdle on the assumptions provided. I will, obviously I sit on the PCC, and we I think tackled some important but maybe some low hanging fruit to say, hey, trade receivables, contract assets, those assets that we don't believe are going to be materially impacted, let's take that practical expedient to not consider, reasonable and supportable forecasts of future events, and really just focus on, current results, with the intent, hopefully, that eases the burden for private companies, but also lessens the sort of audit requirement to then, rigorously audit those assumptions if you can make the expedient. And so I know we had some discussions in a previous session on where might there be other opportunities to provide expedients or simplifications that would take an already, in my opinion, flexible model that inherently should create flexibility, but also maybe simplify the level of rigor needed to maybe support some of those. And I think the comment was, there's a lot of smart people. I think that's a very challenging thing to sort of coalesce around, but I think it's a worthy endeavor, at least based on what we've heard today. And I would just say, as I wrap up my comments, I appreciate the FASB's willingness to work with the Private Company Council on working through some of those, CECL practical expedients and private company alternatives that help simplify. And I think maybe one of my takeaways here today is there's still room to go there. But I think from what we kind of felt in the private company space is a significant application challenge. We, through some of these practical expedients, have been able to make steps in the right direction there. But those would be my comments.
Great. Thank you for that feedback, and happy to hear the amendment was helpful for your organization. Chris, looks like you're next.
Okay, so writing policy is hard. And I always like to say, English is a wonderful language. You have pretty good, pretty bad, pretty ugly. You have no idea what pretty means. So in that fashion, I was, in Appendix C, there was transfer between classifications, held for investment versus held for sale. And we saw an instance where, this is one instance, but we saw an instance where there was a CPA who referred to the black letter, and I'll just quote some ASCII, 948, 310, 35, 2A, and it has in parenthetical this little saying that says about the transfer of classification of mortgage loans into held for sale classification at its amortized cost, parenthetically, which is reduced by any previous write-offs, but excludes any allowance for credit losses. And I had this one CPA where a loan that was a commercial property, a loan on a commercial property, its loss was in excess of 80%. It was transferred to held for sale, and the loss was run through as a loss on the sale. And looking at industry guidance, this industry guidance out there that this is really a credit loss, but with them looking at the regs, sorry, I'm in the wrong world. Looking at the standard, they looked at the black letter, and it created some confusion. So to the extent that as you're going through, and I'm in government, so we talk about plain English all the time. as you're going through and thinking about things that can be clarified, things like that, where we're creating the policy. It's clear to us. It's clear to us. But I spent a lot of time with individuals where English was their second language, and getting back to pretty good, pretty bad, pretty ugly. There can be confusion. So that's my observation. Thanks.
Great. Thank you, Chris. Does anybody else have any observations on this topic? Any feedback on some of the recent amendments we made to improve the operability, like eliminating TDRs or the purchase loans guidance? Sorry, Mark, I see you have your tent up.
Thanks, Alex. And I appreciated your comments up front about making sure that we know this isn't a TRG meeting. I noticed that it was in the context of almost that there could be another TRG meeting. So I'm wondering, is this like the Armed Forces Reserves where we can get called up at any time? I'm going to keep it at a high level. I won't get super technical. I do have a couple of, or a few additional suggestions of things that are continuing to be application challenges that may be a little bit more narrow than some of the other things, but I do want to make sure I get them on the record. The first is forward contracts to buy loans, and potentially thinking about excluding those going forward from the scope of the off-balance sheet credit exposure guidance. I'm not making that comment really from the perspective of the impact of or any concerns about high quality financial reporting, but really more from a cost benefit perspective. I think that given some of the changes in the literature, the main focus of forward contracts to buy loans is on forward contracts to buy credit cards, and on forward contracts to buy loans that are not seasoned, where there's still provision expense recognized when those contracts are entered into. I think it's, again, worth looking at that from a cost benefit perspective. I won't get too much into the detail, but I think just given some of the changes in the literature with PSL and the downstream impacts on forward contracts to buy loans, that is worth revisiting from a cost benefit perspective. So that's one thing I'll bring up in terms of, an application challenge. Another thing that we've seen that really doesn't make any sense at all is in a business combination, the PCD rules do not exclude loans that the acquiring entity would charge off under their charge-off policy. And so what that means is on a business combination, you'll see entities having to gross up loans just to turn around and charge them off. And I see Dan nodding, sort of knowing this issue. I think what we've recommended is that entities, like, they do technically need to do it, but we have suggested to them that they put that charge-off information actually below the table in the allowance roll forward, because we think that measure would be so misleading if they showed those charge-offs together with other charge-offs. It doesn't really make sense that on a purchase business combination that an entity is grossing up a loan that is, grossing up the allowance for a loan it's going to turn around and immediately charge off under its charge-off policy. And part of the reason I think there's focused on that is because you need to do that to be able to have recoveries or include recoveries on those loans in your allowance estimate. Again, don't want to go in. You asked not to go into more weeds. I'm not going to go into any more weeds, but I did want to have that one out there as well. And then the third one, probably needs to be mentioned, which is I would take another crack at getting input on whether the gross up approach should be extended to originated loans. The idea that a loan origination or the acquisition of an asset is a loss event is to me conceptually indefensible. I know it was done for practical reasons. I know that drove some of the original dissents on the CECL standard. I'm not sure, I think that would take a lot of input, again, from a cost benefit perspective, but whether that would be worthwhile to go to the gross up approach. I think that we do have this break now with PSL, a very different accounting for originated and purchased loans, even though they are very similar economic transactions. And I think taking another look at or getting more feedback around eliminating that inconsistency would be really helpful. So I'd encourage maybe the board to think about something like a preliminary views document to just get more widespread input on the appetite and the costs involved in making that change. So those would be three specific suggestions I'd make.
Great. Thank you for that, Mark. Graham?
Thanks, Alex. Well, I'm going to feel very unoriginal. I'm just going to pile on Mark and Doug's comments. With regards to some of the recent PCC standards, I think we would actually advocate for the expedient that amounts collected during the subsequent event period don't require measurement under CECL is something that should probably be available to all companies. That's, again, not super conceptually pure, but I think it's very intuitive to users is our understanding, is that if I know I collected that during, that subsequent event period, why do I have allowance for it? I think that would make sense for everybody, just for the same way it made sense for private companies. And then two of Mark's points I was going to echo. One is on acquired loans that have immediate charge-offs. I think that's something that we've also thought. I was going to suggest separate disclosure rather than not having to apply the measurement standard, but I think either one works. Because to Mark's point, I think one of the things we see is people trying to use that charge-off information to do modeling, and it's when you have one big blip that's not related to their actual exposure to credit, that's hard, I think, for users to make sense of. And then I would also echo the taking another look at applying the gross up method to everything. I think the recent purchase loan standard has exacerbated or maybe made that a less, it's made more prominent the issue. And I think the hard part of CECL has always been measuring the credit losses, not subsequently amortizing that credit loss over the life of a loan, which is, I think, all the incremental work that the gross up model would introduce. So I think, yeah, I agree. I think it's worth revisiting.
Okay, thanks, Graham. John?
I agree with those comments, and I'd throw maybe one more thing on there. We did come to the staff and some board members a while back on freestanding credit guarantees, and how if you bought a guarantee, you could maybe recognize the asset, sync it up kind of with the allowance on the related losses, and what still kind of remains open is on balance sheet securitizations and non-recourse debt, which is very economically similar. And it never really made it. I think there was a suggestion maybe we have a FASB agenda request for it. It didn't come forward, but it's really hard to explain to people if I've got assets on my books and they didn't leave under 860, but the losses are being borne by the debt on the books, why I've got this asymmetry and I've got to recognize lifetime losses, but I can't write down the debt in conjunction and in sync with that. So I'd throw that on the list of items to be considered as well.
Great, thanks. Chris Eckerlin?
So I think mine is somewhat similar to John's, but probably simpler because he's a lot smarter than me. So I think credit enhancements should be revisited altogether. I mean, I think one of the things you tried to do with CECL was to marry up the economics with the actual activities. I mean, you can get a very specific credit enhancement to a loan, and even though now you can have some accounting symmetry in your earnings, they're certainly not in the same spot. And it's a very difficult conversation with management to try to explain to them why they have a credit loss when they're completely protected from a credit loss. I think standard might have gone a little too far in not allowing to use a credit enhancement to protect your credit losses.
Good, thanks, Chris. Christine, you're next.
Yeah, I just wanted to provide a thought on the gross up approach for all. I think that if the board were to take a look at that, and I share the concern about having two very distinct models for essentially the same economics. But one of the things that the CECL model does is it very clearly distinguishes the losses from the contractual interest revenue on the income statement. I'll refer to that as, excuse me, gross presentation, Whereas the gross up approach, as it's currently applied, commingles the loss that exists on the date of acquisition against the interest revenue on a go-forward basis. And so if the board at any point were to ever take that issue on, I just would recommend that that gross versus net presentation issue be part of the discussion, because otherwise I think it will be DOA.
Great. Thank you, Christine. Sue?
Thanks, Alex. I have a question, application challenge that seemed to manifest itself early on in the application of CECL, which was around the adjustments that were termed qualitative overlays. And in particular, my understanding is that a qualitative overlay was oftentimes used when the models weren't actually being responsive to maybe certain factors that needed to be considered for purposes of the reserve. And so my question is my understanding was that there is a lot of scrutiny on those qualitative overlays, particularly the larger financial institutions, and scrutiny from internally, externally from their auditors, et cetera. And so there was a significant push to try and build as possible that those types of issues where the models weren't responsive into the models themselves. So over time, that there was less time and effort spent towards these adjustments that weren't responsive to the models themselves. And so I just wondered if that was still an issue. Maybe the banks or the auditors could comment on that. My understanding was that the process was very robust, but it was very time intensive. And I wondered if, from an application perspective, if that's something that has dwindled over time, at least in the larger financial institutions. I recognize maybe not so much in the smaller.
Great. Mike?
For the smaller ones, I think that's the heart of a lot of the heartburn of because the non-complex models have a number of a whole bunch of things that are not directly modeled in there. So that's that becomes a lot of where the cost issue comes here. From my perspective, also that's part of part of the frustration is that these estimates or whatever, an evaluation, the whole framework is to not really measuring where there might be credit risk. It's only measuring what is a limitation in your model. So it's a lot of work that doesn't get to the to the real root of the business. So, yeah.
Great, thank you, Brett.
Soon, your question. I think my experience is maybe a little mixed on the question. I think certainly as models are enhanced, there are times where something that was captured in a qualitative factor, and maybe in a fairly quantitative way, was then built into a model. But I think we're also seeing that there's a number of factors that are considered in that qualitative reserve that actually building it into the base model may not achieve like a cost benefit type analysis. And so I don't actually see us in all cases getting to this nirvana where everything is model driven. And certainly to my point I made earlier, we've also been in an economic experience where events keep occurring that are just not back tested, not in data sets, and not in modeled results that we keep having to deal with.
So I have Fred and then Matt next.
Yeah, I was just going to follow up on Brett's comment is that I think it's important to think about, and this is why I don't think qualitative factors will ever leave, is that the relationship between macroeconomics and loan portfolio performance, I think as all our regulators can tell you, is not, there's an error term in that for any portfolio. And it's very difficult to find those macro factors that drive, certainly more than 50% of the performance of an individual portfolio, because so much is driven by, underwriting and these other factors. I think, to your point, Brett, I think these models can get better, but it's important. I think as a standard setter, I think, I certainly recognize that they're never going to get to 100% or even close.
Right.
Yeah, maybe just to talk about models a little bit more. I mean, I think as a practical matter, I think choices are made to not include certain things, to not overly, complicate a model. We were talking about model complexity earlier, and so I think in some cases it's easier to address one-off limitations or issues that arise in the economy, through a qualitative and support why you need it versus trying to model in every, various scenario or model limitation that might be there.
Great, thank you for that. Chris?
Supporting the qualitative factors is a meaningful driver of costs. And I don't think for institutions my size, that's likely going to go away no matter how long we have. When we look at the data, specifically some of the smaller loan pools, we will never have enough statistical data to look at that pool and tell us through a model or through math where we're going to land for various categories. So we're either going to be relying on pure data, which we need a lot of cost and support for, or we're going to have to go in there and make qualitative adjustments.
Does anyone have anything else to add, Graham?
The only point, and Brett, you hit on this, but just to draw it out, Sue, I think one of there are a couple things in accounting that have horrible branding problems, and qualitative adjustments is one of them because it makes it sound like it's a thumb in the wind, when I think in my experience, Brett, you hinted, they're usually very quantitatively supported. Like there is data and logic, and it's not just like, I don't know, it kind of feels like an extra 1% here. I'd also throw down push down accounting is another area that needs a complete rebrand, but that's not the point of today's discussion. All right.
Okay, Mike?
Yeah, thanks for drawing that point out, because that's what my understanding was, is that it's scrutinized heavily, but it's very quantitatively based.
Well, I think that's one of the criticisms that we would have for the examples in the standard, the community bank examples where it just says, okay, it was at 100 basis points, but as a qualitative adjustment, we're going to bump it up by 10 bips, and that's it. So somebody thought that that's all you need to do, right? That this would have some sort of less or even minimal scrutiny of it. So,
JP?
I agree. For community banks, the qualitative adjustment is it's fairly significant for a large majority continued. One thing on the issuers as well, in the community bank issuer space, that is often the critical audit matter that's disclosed, just because it's got a lot of subjectivity in that. So that does drive a certain level of documentation as a result as well.
All right, any final thoughts? Although we're doing a great job of staying on track. Okay, let's move on to the final topic, topic 4.
The final topic we would like to cover today focuses on the standard setting process itself and potential areas for improvement based on the board's experience with CECL. As part of the PIR process, one of the key objectives is to evaluate whether the results of a standard and its implementation suggest opportunities to improve how the board develops and issues guidance in the future. In that context, feedback on CECL has highlighted several areas for consideration, including the role of forward-looking information, the differing needs of financial statement users, the challenges of convergence, the effects of issuing multiple major standards within similar timeframes, and the use of implementation support mechanisms such as the Transition Resource Group. Stakeholders have also provided feedback on broader aspects of the process, such as effective date decisions, transition requirements, cost-benefit considerations, and the overall timeliness of standard setting. For example, some stakeholders noted that implementing multiple major standards concurrently created resource constraints, while others highlighted challenges associated with developing guidance over extended periods during which economic conditions and stakeholder perspectives may evolve. Today's discussion is intended to provide the board with insights that can inform improvements of its future processes, not only in the context of CECL, but more broadly across its standard setting activities. We will break up this discussion in 3 points: effective date and transition, standard setting, and then CECL overall.
Great, thanks, Mike. So we have 3 buckets of questions for topic 4 on page 18. I'm going to break this up into these separate sections. So let's start off with effective date and transition, which are questions 9 and 10. Any feedback on thinking through effective date and thinking through the deferrals and everything else that happened with effective date and transition? Thank you, Mike.
Yeah. I'm not sure if it's necessarily effective date or transition, but it seems to me that we really need the auditing standard setters involved in this. And I know that between the time of the standard was the CECL standard was issued up until whatever it was 2020 that came into effect. The PCAOB came out with a new standard on estimates. I think there was other standards on audit evidence or something like that. And this concept we just talked about that I just mentioned with Sue, like this thought that the qualitative adjustment had relatively little to no audit documentation needed was pretty prevalent. And I mean, I think that when we had held some workshops with some of the FASB members that are not on the board now, but the concept was this is just an estimate, right? And that we just here's how we got to the number or whatever. There wasn't a whole lot of sufficient substance as to what kind of documentation would be expected and such. And if you look at, for example, on the AICPA's audit practice, you look, there's a lot of questions there that sets a very high bar for any audit for any company. And remember that banks with over $1 billion in assets have to have an attestation of internal controls. Such, but it sets a pretty high bar. Is at least the number of questions you have to answer in the right way to have a sufficient attestation opinion. I think that there was also an AICPA revision that came effective 2020 that kind of integrated. It was about the integrated audit, and it made the attestation much more closely involved with the audit itself. That in itself, I used to get calls about because it was increasing audit costs by about 20% there. And so these kind of things in the audit realm, they need to be involved about what would be the expectation so that when we weigh costs and benefits or what have you, that at least we come in with eyes open.
Great, thanks, Mike.
Brian?
Mike, maybe just in response to that, I just want to clarify and maybe plug it if I will, but the FDIC recently increased the thresholds for Part 363 and the annual reporting requirements to include the attestation from 1 billion to 5 billion.
Yeah, we're still all trying to figure out how that's actually going to work in practice and such. So, but yep, sure. Definitely like the efforts there.
Okay, any other thoughts on effective date or transition? Sorry, Jay, were you Thanks.
Yeah, we definitely commend the board for the responsiveness in many of the post effective date enhancements that have been made in response to different post implementation feedback. I think all of which have generally been beneficial. Accrued interest, TDRs, trade receivables, not a significant an issue for banks, but significantly purchase loans, I think, have improved both operability and decision usefulness. I don't know, just as the board is thinking about it, if, now having the benefit of hindsight, would there have been a way to try to capture some of those things, prior to the effective date? Notwithstanding just the amount of time and effort that had gone into CECL, as we were looking forward to our business combination that closed just within weeks of CECL's effective date, and foresaw, I think, some of the confusion that subsequently, was made clear through investor feedback on the CECL double count and what the effect of that was going to be. At that time, we did advocate for reconsideration of expanding the double count more broadly, particularly in the context of a business combination to purchase loans. And so, just in retrospect, would there have been a way, and maybe it just wasn't possible at that time, but to have more completely considered that, prior to the effective date. I also think it would maybe warrant recognizing that there's not a precise objective way to fully measure costs. It still would recommend to FASB that, we consider, some effort to try to quantify, recognizing it's an estimate of both, implementation and recurring costs of CECL, such as surveying a population of preparers to understand the types and quantifications of costs, et cetera. Again, recognizing there's not a single method to objectively measure costs. Nonetheless, it does seem like more collective effort could be made, through surveys and targeted, prepare cost estimates to at least try to, put our collective arms around that cost.
Great, thank you for that. So your response intersects nicely with the next three questions on standard setting process, 11, 12, and 13. You mentioned some standards that were issued subsequent to the issuance of CECL to help improve operability and all that. But for the group, as we think about the standard setting process, thinking back to my comments at the beginning, how this has been a 20-year journey almost. Curious what people's thoughts are in terms of the journey that the board went through in developing the guidance that we should think about for future standard setting. Graham, thanks.
Gosh, I don't want to, maybe at the risk of over learning the last lesson or continuing to fight the same war, whatever the appropriate colloquialism is. Building on Jay's remarks, I think CECL was particularly unique in the challenging or maybe political environment in which it sort of the waters it was swimming. It had really unfortunate timing in terms of trying to put it in right as this unprecedented potential credit event happens in terms of, COVID and all that. One thing, and Jay, to build on your remarks, I think something that undoubtedly happened, and I'm not exactly sure what to do about it, this is more just an observation, is I think out of the board's responsiveness to a number of things that came up during the post-issuance pre-implementation process, that TRG process, there were a bunch of changes. And I think it created a hesitancy for some institutions, in particular, kind of medium downsized banks, to start their implementation process because it felt like the foundations were shifting into the point that I remember being within like 6 months of the actual final real implementation and getting questions like, is FASB just going to pull this thing back? I was like, no, we've had like an implementation period of 8 years. I don't think they're going to pull it back now. But we got those questions. And so I don't know exactly what to do here other than to say that there is a balance to be struck between providing certainty, enough certainty that people can get going while continuing to be responsive. And maybe there's a timing of just like, we're going to go with the first thing and we'll do some of the adjustments later. I'm not sure, but just and again, CECL may be just unique. And so I'm not sure if that's a lesson to be learned, but it is an observation of what happened.
Great, thanks. Mark, you're next on the list.
Yeah, I'm not sure if this is going to be contradictory to anything that Graham said, but I actually thought, and it's called out in the materials as a little bit of a best practice in the way that the TRG functioned, in that there was a TRG discussion. The TRG members were not asked for consensus, but the staff and board took it away, and the implementation questions that went to the TRG were ultimately codified into the codification, so that there's one source of authoritative guidance, right? Like you don't have to look to the codification and the TRG materials, right? Because what's relevant got into the codification, and that also subjected those issues to due process, which is really beneficial in standard setting, obviously. And so I agreed with those portions of the materials about that part of the TRG being sort of a best practice, right? The TRG was just a provider of debate and input, which I thought was really good, versus some sort of separate standard setting body. There were, as the materials also refer to, a couple of Q&As that were issued that were not put into the codification and led to confusion about whether there were practical expedients being created that were not provided for in the standard. I think those were isolated, but now as we start to think about the need for practical expedients, which I will say practical expedients have a very important role in financial reporting, and it'd be great to have dialogue about potential practical expedients. But I want to bring up this as part of the standard setting process to say that if we're talking about practical expedients, especially ones that deviate in some way from a best estimate of expected credit losses, that there's a right way and a wrong way to do it. And the right way is to put it in the codification and subject that to due process, including the impact from a variety of constituents. So I want to make sure I noted that just from a standard setting process perspective.
Great, thanks. One thing I'll just reacting to the comment on the TRG, we often get asked to do TRG for different types of standards. And so to the extent additional people want to talk about the TRG process, it'd be interesting to understand if we were to, where would you draw the line in terms of how big of a standard would merit a TRG? Because obviously not necessarily everything requires a TRG, just something to noodle on. So next on the list is Mike.
From a transition perspective, going back to that, I think the banking agencies did something very good, excellent, in regards to the regulatory capital transition, not only at the day one implementation, but also throughout the, I think 2020 and 2021 or something, during the pandemic period. We think it was very effective. And it was responsive to both concerns about CECL being whether we're doing it right, and that's the first one. And then the ongoing was to control volatility. I think there has been a study about that. That lending did pretty well during that point, and you saw the capital relief come back through capital, within the next couple of years. I think that's probably a model that I think the agencies need to think about as in response to any kind of crisis period. So, well done.
Right. Thanks, Mike. Chris?
I'd like to echo the comments around certainty around the dates. It's not a good environment to have institutions or businesses waiting because they've seen extension after extension and are hoping, and at the time the political environment was encouraging that CECL is going to go away. And that put the institutions that were doing the reasonable thing, the appropriate thing, and getting prepared at a disadvantage. So I faced at least a couple years of overlapping costs that the institutions that were waiting or, crossing their fingers at 6 months and saying, this is going to go away. It put me at a disadvantage to them. Ultimately, the institution I was at actually adopted CECL technically early for its size and being a non-public, which came with its own problems. So to avoid continued overlap expense, I adopted early. And then I was the first guy through the door as far as external audit, outsourced internal audit, to show up and say, all right, we're going to go through CECL. And lucky me, I get to be one of the first banks my size. So I didn't win on either end with all of those extensions.
Yeah, thank you, Chris. Brett?
A couple things. I think, at the time, the board was very cognizant of the big three standards coming out at the same time and ordering that. I think in hindsight, maybe the system underappreciated non-accounting factors going on at the same time. There's, a tremendous amount of scrutiny on data governance, on model governance, on capital stress testing at these institutions that really stretched resources in that implementation time. And I think in hindsight, maybe some of those things were both bottlenecks and resource issues, maybe even more so than some of the other accounting standards. And so I think making sure we understand like the full environment of what's going on in implementation is important. And to Mark's point around identification of some of these issues that ended up in the TRG early, we always say field testing is so important. And I think, I look back in hindsight, your doors were not being beaten down by people wanting to participate in field testing. But I do think in hindsight, like whether it's broad field testing or issue by issue field testing, I think that type of process for this type of standard is really critical to surface issues that ultimately surface, but maybe could have been addressed earlier.
Okay, thank you for that feedback. Doug?
Yeah, I have a few comments, but I wasn't planning to comment on this, but the topic of the certainty is one that I kind of smile at, because while I may not have a ton of experience in the CECL, especially for financial institutions, I have a lot of experience with the leases standard. Yeah, for those of you who know me in the room, I was not going to not drop leases today. But it's funny because the leases standard was following the same journey as CECL, right? It was pushed back a number of times. There were plenty of companies out there, particularly in the private space, that were just sitting on their hands 3 months, 2 months, 1 month before adoption, and hoping and praying that maybe it was going to get pushed out again, or maybe it was going to get stripped. And it's an interesting dynamic because personally, I love that the FASB is reactive and responsive to the realities of the world around us, and that they're willing to push standards back when the needs arise. But the unintended consequence of that is it creates uncertainty as to, well, what about this or what about that? Are they going to push it back? And so, I mean, I think I wouldn't want to swing the pendulum so much one way where it's like, nope, this is date certain, this is when we're going to adopt, when the standard's going to be effective. Because I don't think that does justice to the reality that we live in an uncertain world. So just thought I'd comment on that because I couldn't help but smile listening to the conversation. Specific to private companies on effective date, I love for big standards, 2 years minimum. Let the publics go first and clear the way for private companies to learn. I think that's something that the FASB's done a great job learning from with other large standards, and I would love to continue to see that be the case going forward. I think there was another comment earlier about the need to continue to think about practical expedience, and then there was a comments around the FASB Q&As that came. We spend a lot of time as a PCC talking about this. A lot of what we do as a private company counsel is consider expedience alternatives for private companies to simplify. And as we all know, going through the standard setting process and the due diligence required to get a practical expedient takes a lot of time. And what we've oftentimes found is that these Q&As, these opportunities for the FASB to put out what I would call more educational type material, where more times than not, that takes a standard that it's already in the standard. It may be things that are buried in the basis of conclusions that by highlighting those things in a Q&A, one, we can move faster on that. And two, it may take, because I think the WARM method, where there was a Q&A on the WARM, I'm not even that familiar with the WARM method other than I know that there was a Q&A on it. And it wasn't, in the standard, right? But it gave enough sort of authority feel to where maybe the auditor was like, okay, you sort of following through the example. So I think there's a lot of opportunity for that type of guidance. Now, I know it hasn't gone through all the due diligence and it's not necessarily authoritative in nature, but I think we're starting to see, at least in my 6 years on the PCC, more often this type of communication coming through these FASB Q&As that may not always take the place of a practical expedient, but could provide that much needed clarity or guidance for both preparers and practitioners alike on how we do that. So I think it's just it's an opportunity in the standard setting process to wait and consider where we really think, yes, this absolutely is something we need to address in standard setting versus where maybe it doesn't. Maybe it's in the basis. It just kind of needs to get pulled out a little bit and highlighted through a Q&A. So, yeah, I think those are my comments.
Great, thank you for that. Yeah, you make a fair point on the deferral of the effective dates, and I guess the solution to provide certainty, right, is to never defer an effective date. But the reality is we listen to stakeholder feedback and try to be responsive to the feedback. So that's the tension that we deal with. Not seeing any more tents. Maybe we move on to the last final section of this topic 4, which is just overall thoughts on CECL, questions 14 and 15. Anything that we missed or didn't cover in the past few hours that we should be mindful of? All right, that's totally fine. So I want to thank everyone for joining us at this roundtable. I realize it's not the easiest thing to take time out of your schedules to join us and participate in this. As I mentioned at the beginning, the feedback that you're providing today is incorporated as part of the broader PIR process, and it will be incorporated into the PIR report that we are planning on issuing later this year. I also want to take a moment and thank my team on this end of the table for pulling together the materials for today's session. And I also want to thank our support staff who work behind the scenes, who never get seen, but are critical to pulling this thing together. So Melissa, Michelle, Patricia, and Colin, thank you. With that, I think I see one final. All right, Mike.
I just can't shut up. So would this be, I'm thinking about like the recent purchase season loans and the disclosures. Is that like feedback about whether they're working out? That's a separate process. And so this kind of closes the book on general CECL, or is that what we should expect?
So what we're doing now is we're compiling all the feedback that we've received so far, including any additional feedback we've gotten, right? And then we will present it to the board for the board's consideration. Then I think it'll be up to the board to decide how they want to handle that feedback.
Oh, okay.
Okay, great. I think that's it. This meeting is adjourned. Thank you all.